Nilesh Shah is with us from Envision Capital, of course, to get some more perspective in. Nilesh, it's dizzying, it's crazy, it's up one day, it's down another. Within one night itself, it's, so many different cycles. But my question is that now that there is this 90-day pause, and we know his mind has shifted, he's understood that you can't completely destroy markets, Mr. Trump. Do you think we're past the worst?
It's hard to say we've passed the worst because clearly there's so much of volatility. Every day, decisions come, new decisions come, previous decisions change. So till we do not get to a stage where countries sign up on these bilateral trade agreements, it's always going to be hard to kind of really say whether the worst is behind us. But I'd at least say that the kind of uncertainty which has unfolded in the last few days, and the fact that the markets have already kind of been on a consolidation or a correction mode for almost now more than 6 months, I'd say that a fair bit of the damage is already done. I mean, I haven't seen the sentiment as bad and so many words of caution coming in versus what we have heard in the last maybe 3 to 4 years. So to that extent, I'd say a fair bit of the damage is done. In fact, maybe investors run the risk that if there is basically a final settlement to this chaos, you're going to be caught off guard. So clearly, I believe that a fair bit of the damage is done. Valuations are turning attractive. It's just more now getting into more of the bottom-up mode to kind of build a more long-term portfolio. So I'd say that, yes, a fair bit of the uncertainty is behind us, but you can never say that it's entirely over.
Sure. Nilesh, so one specific question on IT services companies, and we've discussed this in the past. You're obviously very bullish on digital and internet businesses, but traditional IT services, I mean, look at TCS. I'm not getting into what they did in Q4 or not. And Q4 was their worst quarter in FY25. But even if you look at backdated numbers, in FY23, the company, this was just after COVID, company, came off 13-14% kind of growth. FY24, TCS grew at 3.5%. You can argue there was base effect over there. This year, it's ending with a growth of 4%, minus any tariff or global uncertainty. How should investors look at the IT exposure they already have in their portfolio?
So if you're not a benchmark indexed investor, you're not hugging the benchmark, then there's actually no reason for somebody to be in the large cap IT space. And this is not just a recent phenomena, but clearly with the huge base effect, even if I were to kind of look at it for a very long period of time, when the US has been on a roll, technology spending has been quite phenomenal, our large IT services companies have probably been growing in mid to high single digit, at best 10%, in local currency. So if you actually remove the currency depreciation, the growth is even lower. So clearly, these are businesses which probably have been growing at about 5%. And you kind of mentioned that data point even for the most recent times. But I think that's true for a very large part of the last 5 to 10 years. And I don't see this changing meaningfully unless any of these companies do a very big pivot. And I think they've now grown just too big that I think it's going to be very difficult for them to do a mega pivot. So to that extent, unless you are a benchmark kind of oriented investor, honestly, I think within the world of IT services, there are many more other bottom-up opportunities in the tier 2, tier 3 space, which are doing some really specialized work. So that should really be the focus segment. I would probably think of the large cap IT to be more like kind of a value play, where you suddenly see it too beaten down, you want to participate in the market, maybe at some point of time it becomes a good value play to kind of buy into and maybe hold it for the next 6 to 12 months and see stock prices go up and you exit out there. But beyond that, these are single digit growth businesses. Of course, these are fabulous companies, the kind of capital efficiency they deliver. So they are great companies, but probably not great investments.
Absolutely. And I think I put it right there. Nilesh, hi, morning. So talk to us about one or two bottom-up ideas. It's been so much macro last few days. But it's at the end of the day, if you're going to make money, you've got to buy some stocks, right? And I think it'll be helpful for our viewers if you can. Just, of course, with full disclosure.
Yeah, without getting into individual names, but clearly, Prashant, I think the 2 or 3 opportunities where I'm still kind of extremely excited about, and they've got nothing to do with a global slowdown or a global recession or anything to do with tariffs, but clearly One is the whole digital space, and there are plenty of fintechs out there. There are some of these consumer internet companies, which I think continue to kind of do well. No matter how much of bashing that we do around food delivery or quick commerce, but this is really probably the fastest growing segment that we have in India. Clearly, payments is again a very, very exciting opportunity. Clearly, where the whole
I think Fino payment is. I mean, if you allow me, is that name? Would you like? I mean, you already own it.
What we own are both Fino Payment Bank and Paytm. These are the two companies that we own. One is a bank, the other is essentially a payment platform, but getting into essentially a whole range of financial services. These are two businesses that we have been owning for some time, and we continue to really like their long-term prospects. And the stocks prices have corrected meaningfully without any kind of an impact from a US slowdown or this whole tariffs thing. So they're clearly domestic-driven opportunities where penetration levels are low, and the growth potential is quite massive over a medium to long-term horizon. So these are some of the spaces that we like.
Just very quickly, a follow-up on payments, Nilesh. You would have seen this, right? One of the regulatory issues that came out from the monetary policy was finally RBI saying that maybe we should have MDR for UPI transactions now, at least large UPI transactions. They're still, I think, considering it. They'll figure it out and decide how it needs to be shared between NPCI merchants, etc. But could that be a big kicker for a stock like Paytm, or do you think it will be only marginal at the periphery?
No, it will be a very big kicker. It will be a very, very big kicker. And the company had also been guiding that they would turn EBITDA positive in the quarter gone by, and maybe at some point of time, they would also turn basically positive at the net earnings level. And I think clearly one of the things that will drive that will be basically the ability to charge MDR to large merchants. And that's going to be massive, because currently it's not that through other modes of payment, the merchants don't pay MDR. They do pay MDR for credit card transactions, and those numbers are quite meaningful, quite significant. So anybody who has a business which is relevant for merchants, and especially for millions of merchants, I think that's a big kind of an opportunity. The other essentially is the optionality that they sit on, that when you are serving payment products to millions of merchants, you essentially can cross-sell many other financial services products. And a start has already been made in that direction. But basically, there is a significant optionality that is sitting out there. So these are the kind of businesses which I would probably think are relatively immune to the current, the not so favorable external environment.
All right. Hi, Nilesh. Good to see you. And as always, Nilesh, for this week itself, the FMCG/consumption pack has made a comeback. And normally in times of uncertainty, the FMCG/consumption index has done better, barring this time around, because in the last 7 to 8 months, it's actually underperformed what the Nifty has done. What's your view on this sector? Because it's got some tailwinds. Commodities have crashed, so packaging cost will come down. Demand is expected to come back because Indians will have a high amount of disposable income. So that's the hope out there. And at least as of the recent predictions, the forecast suggests that the monsoon is going to be pretty okay. Your view on this theme?
Clearly, consumer is likely to outperform. I think it's very well poised to outperform. I clearly believe the roots of that were laid out on the 1st of February when, the massive tax exemptions were extended to India's growing middle class. So clearly that was the first trigger. And second is now basically the crash of crude. Clearly augurs very well for them. That's going to help them to expand gross margins and the operating margins as well. And that's been a space which is not done so well in the last few years. So I think it's poised for a fair bit of outperformance. And the trick is going to be to essentially identify select categories. I mean, of course, there's a broad consumer staples as a category, and businesses around soaps and maybe shampoos probably are relatively more mature and are highly penetrated. But some of the other emerging categories like beauty, personal care, feminine hygiene, maybe dairy products, that's really a segment which is still very, very early in terms of the penetration. And those are the kind of categories which will witness significant acceleration in the years ahead as India grows and as the average Indian becomes more aspirational. So clearly, consumer as a space is poised for some really decent outperformance.
So, Nilesh, what's the final advice? If you talk about, okay, let's say the next 12 months, right? 12 months, how much do you see the market rising? And let's not take Nifty 50, let's broaden the scope, even if it's a Nifty 100, but at a broader, index level, what do you see ahead next 12 months?
At the cost of going wrong, Surbi, but I would think that basically the markets would be higher from where we are today. I clearly believe over the next 12 months, a lot of this dust would have settled. I would expect, the government of India and the policy makers to unleash the next round of reforms. Third, inflation is trending lower. Interest rates would essentially be lower. And some of the most recent policy initiatives will begin to play out over the next 1 year. So I clearly think, and on top of that, I expect foreign investors to come back, given the kind of headwinds that they see in the United States. I would see increased allocation for emerging markets, including for India. So I think on the whole, be it fundamentals, be it liquidity, or be it sentiment, a combination of these three things, based on that, I would expect the markets to be higher a year from now versus where we are today.
All right, and Nilesh, on that positive note, we'll leave it here for now. Thank you very much for coming on this morning, talking markets and what you like in the markets at this point.